Everybody, my name is Jacob Gellman, and I am a PhD student at University of California, Santa Barbara, and this is joint work with Judd Boomhauer, Meredith Fowley, and Andrew Plantinga, and the title is Wildfire Risk Modeling and the California Insurance Market. So, big issue in California right now is that wildfires are becoming more frequent and more severe, and these are posing huge damages to the insurance industry. You can see in 2017 and 2018, huge losses among insurance companies. And how are insurance companies responding? Well, they are dropping homeowners from their policies. And a lot of the reason they're dropping people from their policies is because they are price constrained in high risk areas. So, a couple of key regulations in California that constrain insurers. First of all, California is a prior approval state, so any insurance premium must be approved by the state insurance commission. But importantly, rates must be justified by company-specific historical loss experience. That means that insurance companies charge based on past realized damages rather than forward-looking expected damages. And this is a problem for wildfire because we know that damages are expected to grow in the future. Lastly, there's a binding constraint of 7% premium increases for any insurance company asking for a rate increase. We have a couple of research questions here. First, are insurance premia actuarially fair in California? And what that means is that an insurance premium should be equal to your expected losses. That is your probability of a loss times the value of your house. Next question is, do we see evidence of rate suppression in this market? I implied that insurance companies can't charge enough to high-risk customers, so we want to investigate that. Also, we want to know, are homeowners in urban areas cross-subsidizing homeowners in high-risk areas? So our approach is we're going to compare offered homeowners insurance prices to physical measures of fire hazard. We're going to use three data sets for this. First of all, we look at public insurance rate filings by insurance companies. So these are all available online, and you can reconstruct insurance prices for any company. We're going to combine that with housing data from Zillow, as well as fire hazard data from the Forest Service. So here's a map of a representative house. If you were to take the same house and move it around in the state, how much State Farm would charge that customer for their homeowner's insurance policy. This is a map of fire hazard in California, and the measure is called a risk to potential structure. So roughly, it's the probability that a house would be destroyed by a wildfire in any given year in percentage terms. So our empirical approach is we're going to run a linear regression for a house, and these are real houses in California, where the left-hand side is the premium that it would be offered, comparing to the expected loss on the right-hand side. And the question is, do premia rise one-to-one with expected losses? And does this vary by fire hazard? So when we run this regression for different bins of fire hazard as measured by the Forest Service, we find that at low levels, insurance premia rise faster with risk, and at high levels of risk, insurance premia rise slower with risk. And if there were actuarially fair insurance, we would expect that premia rise one-to-one, and that's not what we find. So a few observations. Above 0.2% probability of parcel destruction, premia no longer rise one-to-one with fire hazard. And when the annual probability of parcel destruction exceeds 0.4%, insurance premia do not cover expected losses under current price levels. This applies to more than 370,000 single-family homes in California, and the replacement cost of these homes is over $120 billion. We also find that homes in low hazard areas appear to cross-subsidize homes in high hazard areas, as manifested through insurance premia. That's all I have, and thanks for attending my flash talk.